I was doing day trading back in 2003, and I ended up losing about $100,000. And so when I finally got my tax situation straightened out, I had this giant capital loss on my tax returns. And I wasn't doing any trading, so I just had minus 3,000 every year.
It's bullshit that you can only write off 3. Like,
Yeah.
you'll get taxed on an infinite amount of income, and then you get this tiny little sliver where it's almost like they're just pissing on you.
I think taking that $50,000, going to Vegas, putting it on black, and then losing the $50,000 is a better use of money than sending it to the government.
Hey everybody, what's going on? Welcome back to Remnant Finance Podcast. We've got something a little bit different here today. We're joined by the team Tax Sherpa. We've got Neal McSpadden, Serena Cooper, and Fatma Manguinin. Did I say that correctly?
Yes.
All right, perfect. So what we want to talk about is we're going to discuss the low stress options trading that we and a lot of our clients, and also Neal himself, are new members of and practicing now. And so over the course of the last few months, a lot of our clients, Remnant Finance clients that are doing, infinite banking or however they found their way to Neal and the team at Tax Sherpa, a lot of us have been adding this new element to our asset strategy. And so there's obviously a tax implication here. And so Neal reached out and wanted to set up a discussion so we can talk through what should we be thinking about now. Everyone in our sphere that is doing is doing the options trading hasn't had a tax return that reflects that yet, unless guys have been doing their own thing on the side for a long time. But for most of us, it's new to our current tax strategy. So what do we want to look out for? How can we possibly think through ways we could prepare now and set up for the rest of this year to kind of absorb some of that tax? What can we do moving forward? And then also we're going to take some questions from our group of clients who are considering this and thinking through this. So we want to have a general tax discussion. We want to have an option specific tax discussion, and then we'll just go from there. So without further ado, welcome to the Tax Sherpa team.
Good to see you.
Thank you.
Yeah.
All right.
It's a thing that we keep getting. So, obviously we talk to new people all the time and they say, I've got this new thing I'm doing this year and, I'm doing this options trading. I'm saying, oh, you're in low stress options? Yeah, and the next question obviously becomes, well, how much you make it, right? Because it does have a tax impact, like you said. And then we have to start planning around that, around what people, think they're going to make, which is always a challenge as market conditions change, like we've seen in the last few weeks. So everything's always to be determined when it comes to, the gains.
Yeah.
And I don't know that those gains are as straightforward as we think. Those people who are doing it, what they provided was a pretty cool tracker that shows what your gain is each week. So what your profit is. But, the common thing you hear from folks that have been doing that kind of trading for a long time, including the guys who run it, is that, everyone says, of course, like I can't give tax advice, but when we get our paperwork from Schwab or from Robinhood or from wherever it is that they're using for a brokerage, that it tends to be lower than they anticipated. So it's which makes it even more muddied because we're tracking one specific metric and the brokerage houses are tracking an entirely different metric.
Yeah. Yeah. So I'll give you the quick rundown on how these things do get taxed. So each contract or each stock is a different thing, right? So, when you sell to open an option, you are collecting premium. And let's say everything goes great, right? You sell to open, you collect premium, it expires worthless, it goes to zero, right? So that whole amount is going to be short-term capital gains, which is going to be taxed at whatever your ordinary rate is, depending on your total income for the year. But once you start doing other things, it gets more complicated, right? So in 99% of cases, it's all going to be short-term regardless. But if you get assigned, so now you have a stock, which is going to have its own, purchase price based on your exercise price of the option. And then it's going to have either a capital gain or a capital loss, depending on, how you trade it on from there. If you start to sell covered calls, that's a separate contract, right? If you're rolling options, you're closing one at a loss and then you're opening a new one with a new premium, right? So, what you put into the tracker may or may not have anything to do with all of those different transactions that actually happened. And so, there's a couple different, degrees of freedom here where, what the tracker is tracking is dependent on what you put in. And then, so there might be some issues there. And then, the tracker is kind of looking at your account on a holistic return on equity sort of position rather than tracking each individual taxable event chunk by chunk. But when you get the report from Schwab or whoever, that it goes each individual trade one at a time, and then it summarizes everything into the summary reports that you'll see, in the 1099 package. I will caution you that if you're an active trader, if you're doing a lot of contracts, those packages get thick. So they're all PDFs these days, but in the old days we used to get those delivered by mail. Some people still do, and they get hefty. But there is a summary page, and Schwab puts it in the back. So if you're on Schwab, you got to go to the end of the thing to get a summary of all the different pieces.
Is there anything? So I know there's like you could do real estate. Like I have a few rental properties, but I'm not a real estate professional. I don't get that tax treatment.
Right.
In the same vein with trading, I'm assuming active trader is a criteria different than just I have a portfolio and I make a few trades every month. Like what is the threshold there? And is that something that we want to get, or is it something that we don't want to get? That treatment. Yeah,
usually you do not want that. So there is a professional trader kind of designation that you can elect, and basically, maybe it applies when trading is your business. And there's a couple different criteria in that definition where, you're engaging in substantial trading activity every day. It occupies an amount of time, each not necessarily every day, but on a regular basis. And the major difference between an active trader and a passive trader is that if you're an active trader, you go mark to market. So instead of looking at all the different trades throughout the year, you start January 1, my account is here. December 31, my account's here. That's the gain I'm going to be paying taxes on, even if I haven't sold anything, right? So the vast majority of time, that is not going to be what you want to do, because you lose any potential long-term capital gains treatment, which is preferential over short-term capital gains. And especially if you haven't sold anything and you're just sitting on your investments, then you'd have to sell something or get the cash from somewhere else in order to pay the tax on it. So it can go against you in a hurry. But if you're a market maker and that's your job and that's your business, then yes, that makes sense to do. So
what is the value of doing that?
Well, the value of doing it.
Reason?
Yeah. So the value of doing it is that if that is your business, then you can start to apply. It basically converts it into ordinary income, and then you can apply expenses against it. So if you have an office building where you do your trading and you advertise, to bring people into your organization and that kind of stuff, but that's not going to apply to the vast majority of people.
Okay. So that we can kind of scratch off for our clients because they all have a primary occupation. They do some trading on the side, but we don't really have to worry about, don't opt into being a professional trader. Don't try to get that status because it doesn't apply anyways. And it's not like we want to show every hour of real estate we can, if possible, to get that status. Like this is a separate thing. So, all right, check that off. We're not going to pursue that. What about, so can you talk about offsetting capital losses? And I'm going to take a stab at it, but if I recall, $3,000 can be offset of loss, and then beyond that, it gets carried over to future years. Is that the same here, or does that not apply?
It is the same. It is the same, but people get confused on this a little bit, where it's the $3,000 net. So let's say you're trading options and you have huge gains and you have $50,000 of gains, okay? And then you have losses against that. You can deduct in the current year up to $53,000 against that, so that your net position ends up at minus $3,000, okay? And then, so example one, you make 50, you lose 53, you're at minus 3,000 for the year, over and done. Version 2 would be, okay, you make 50, you lose 100. You take 53 of those losses in this year, and the remaining $47,000 of losses will carry over into the future. Okay? And then the first $47,000 you make after that will be, netted out against that loss, or you continue to write it off at $3,000 a year. So, as an example, back in 2003, the reason I got into tax trouble and got into the business that I'm in was I was doing day trading back in 2003. and I ended up losing about $100,000. And so when I finally got my tax situation straightened out, I had this giant capital loss on my tax returns, and I wasn't doing any trading, so I just had minus 3,000 every year for however long. I still have minus $3,000 a year, which will be offset a little bit this year because I have dipped my toes back into the options trading game. And so that just gets whittled away every year at $3,000 a pop. But I've had people come in and think that it's like, oh, I made $50,000 in options trading, and I can only deduct 3,000, so I'm at 47. Well, that is not true. Okay, you can it's after everything's said and done, minus 3,000 is the most you can take in the current year, and then the remainder rolls forward into the next year.
Wait, so you said you make 50, you have a 3 loss carryover. It's not 47 is what you're taxed on? Or did I mishear that?
No, I'm saying if you make 50, positive 50, and you lose 100, then you have minus 3,000 this year. 47,000 is going to carry over to next year. But you could have plus 50 at minus 25, and now you're at just plus 25, and that's fine. So the amount of loss is limited to the gain and an additional 3,000. And it's so like I was trying to say, some people think it's just the 3,000, but no, it's the amount of gain plus 3,000 is the total loss you can take in the current year. So if you're doing this options trading, and on the other hand, maybe in a different account or same account or whatever, you have a portfolio that has some things you've been holding for a while that are in a loss position. The strategy is called tax loss harvesting, where you harvest the losses that you have sitting there, and that's going to offset gains you have on the other side.
So for a lot of people who have moved the majority of what they keep market based, who are within the low stress trading platform and seemingly being very successful, right? That's not going to be much of a play. It doesn't seem like they're going to show a lot of losses. Or will that be based on the accounting of how Schwab kicks it out versus what they believe they're making on their weekly income?
Well, there's some of that for sure. But yeah, I mean, some people are going all in. We're seeing that a lot, because they start to, it's like, oh, I'm making 1.3% a week or whatever it is. And so they just take whatever they had, as their dry powder, and then just dump it all in and start trading that. So, if you don't have anything else, then yeah, you're going to be whatever your net position is when December 31st rolls around in terms of taxable gains and taxable losses. That's just going to be it. But the tax loss harvesting is useful if you have these other things. So there's a company out there called FREC, FREC. And if you are wanting to buy the S&P 500 and indexes like that, they have a really interesting approach where instead of buying an ETF or mutual fund of the S&P 500, they actually buy all the different stocks for you. And they manage, the fractional shares and all that kind of stuff. And then as individual stocks drop, in that they sell those at a loss and will replace them later so that they track the overall index, but they're constantly building up a tax loss harvesting position. So, but it depends on your allocations, right? It depends on what you actually want to do in the market. So if you're all in on the options trading, all that stuff's not going to help you because you don't have that other stuff. But for those people who have a more balanced, I have my options, active trading type account, and then I have a passive long-term investment kind of account, then that can become an option for you.
If you're going back to rolling an option, for instance, you're buying to close the position that you initially opened.
Yep.
And you're selling to open a new one further down the road. And if hopefully these terms make sense if you're listening. If not, basically, you have one transaction that you're paying to close out a position and another one where you're getting paid to open. And ideally, you're getting paid more than you're paying to close. So you have a net positive there. You pretty much exclusively make this move when it gives you a net positive. So I have to buy a position for $10 that I opened earlier. I buy that one back for myself at $10, but then I sell another one for $14, and now I make $4, times 100. But just that $4 is the only number that matters in that one transaction, right? There's nothing with the fact that I purchased a position and now I'm selling it at a loss is how it should work. Of course, I'm netting out positive with the overall premium, but the part that I'm buying down, that doesn't matter in this one transaction's equation, right? The only thing that matters is the net profit or loss when these two things are weighed against each other. Does that
well,
make sense?
At the end of the year, that is true. But on the tax basis, those are two different things. So, you opened the first option, you bought it back for a loss, so that you're gonna have a short-term loss for that one contract. Then you have a new contract that you opened and hopefully closes positive, closes for zero, and that's going to be a gain. And so at the end of the year, everything gets added up. All your positives, all your negatives get added up, and you end up with a final capital gain. And so it kind of depends on what question you're asking. Are you asking, like, for me, as far as my account, I only really care as the number going up, right, over time. And in that case, I only care about the $4. But when it comes to the reporting side, each of those different things are different pieces of the puzzle that all get allocated separately.
And this would matter a lot more if they didn't have this. I'm going to guess arbitrary and cynically, it's just kind of it's bullshit that you can only write off 3. Like,
Yeah.
you'll get taxed on an infinite amount of income, and then you get this tiny little sliver where it's almost like they're just pissing on you. Like, have a little bit back.
Yeah,
You
and
get
there are some
$3,000.
states that
You
don't
make
even
$1 million.
allow that. So just
Is there okay? Cynically, I think that's just because why not? Why would we not write this rule?
Yeah.
Why not give them a breadcrumb? But there's no, like, that's almost a negligible amount of money for most people.
Yeah.
As far as, it's not that you're saving $3,000 is not a negligible amount of money to a lot of people, but getting to write off $3,000 of income and offset your taxes, your taxable income by 3,000. I mean, that's a drop in the bucket for just about anyone. Like, poverty level, that's still a drop in the bucket. I would think it's a couple $100 maybe, but so is there any background history or why that's the case?
Yeah,
Or is
so-
it just
So there's kind of two elements. So one is, it is very heads I win, tails you lose. Because you're right. If you do have a gain, you're paying tax on the whole thing. If you have a loss, tough luck, right? And like I said, some states don't allow losses at all, and then you just pay on gains even if you had losses before. So there is that element. And the other element, though, is that this was created back in the, I want to say, 1950s, and it was never inflation adjusted. So I saw somebody making some commentary on this particular number and said, like, well, in 2025, that would be like the equivalent of taking like a $25,000 or $30,000 loss. So, the fact that they haven't inflation adjusted it is arbitrary, because some things are and some things aren't. And it just depends on what the legislation says for that guide to that particular section. And so, you could make the argument that it, maybe it's an oversight, that they didn't think it would be that big a deal, that the 3,000 was never adjusted. But, I'm probably as cynical as you guys. So
that also overlaps with, like, another way that they do the same thing is for gambling. I know you can offset gambling losses, but only by as much as you win. So if you lose $50,000 gambling and that's all you do,
yeah,
you don't get to claim a loss. But if you win $50,000 and you also have tickets showing a loss of 50, you can offset that, but it only works in one direction. And so
Yes.
theoretically, hypothetically, if you were to be a client and friend listening that has placed a wager at a sports book in Las Vegas for me in the last couple months, and that ticket lost, and that was a hedge for a larger bet, theoretically that person could offset losses at all, or no, only if they win, right?
Only
So
if
if
they-
you have a $5,000 losing ticket, you can't do anything with that. You can't offset any gains. But if you go and win $5,000, then that 5,000 wouldn't be taxed. Is that correct in this hypothetical made-up scenario?
in this hypothetical made-up scenario, that is correct. Now, there is a wrinkle with this, in that the One Big Beautiful Bill Act that was passed in July has limited the gambling losses even more. So it's really disadvantageous to have gambling income, even if you have gambling losses. On top of that, it kind of runs, gambling kind of runs in the same rule as hobbies. So if you make money in a hobby, you pay taxes on the gains, assuming that you're worth them accurately. But you do not get to deduct losses because it's a hobby. So hobbies cost money, right? So same kind of thing with gambling. So if you make money, you pay taxes. And if you lose money, that's just money that you spent because you're a hobby of gambling, effectively. So yeah, it's the thing about the tax code is that it's a series of carrots and sticks, right? And so they pass laws to create advantages for certain things that they want you to do, and they have other taxes that are disadvantages for things they don't want you to do. So gambling is very much one of those things they don't particularly want to encourage.
Yeah.
So
That's unfortunate.
so what I'm getting from this, to go back to the people who are doing options trading,
Mhm.
is at the end of the year, it's basically going to show what their net gain was, which is what they're probably tracking.
Hopefully. Yeah. Now, you can also go into most brokerage accounts and you can run
Mhm.
a capital gains report, before the end of the year, and it should give you a number as far as what you're currently looking at.
But I would think that the reason that most of us or most people say that they're pleasantly surprised by less taxable income when they get their statement from Schwab or their brokerage is because, going back to the beginning at what we talked about, the way that the tracker would track, for instance, your cost basis. If you get assigned on if you have a $20 stock and it gets assigned, it counts that as $2,000 towards your total balance, even as the stock drops down. So if the stock is $15, Schwab is going to show that that's $1,500 of equities, and your tracker is going to show 2,000. And so if the numbers of your profit and everything is based off a different total value of your account, then it will obviously will reflect differently in the tracker than it will at Schwab. So really, for tax purposes, we only need to be looking at what Schwab or a brokerage is saying. There's no point in looking at your weekly income, your total income, or anything from the tracker. I don't think, unless maybe the team at Low Stress Options could explain if that is not the case. But right now, just focus on what your broker says for your total taxable gain at the end of the year. That's pretty accurate, right? And it's all short-term capital gains, so it's all going to be based on your income.
Yep.
So that gets into the next discussion that a lot of people want to know about is like, all right, well, let's just assume I'm going to have a large short-term capital gain from this because it's going to be part of my overall tax strategy. There are other things I can do to offset that. Like the way that I view my rental properties right now is the cash flow is nothing. It's a mere trickle compared to what I hope to do and am currently doing in the trading account, right? So if I were only doing it for the cash flow in the rental properties, I would sell the properties. But having those properties is such a big tax sponge is the way that I think of it now.
Mhm.
So what things can people do now to set up, or what other assets serve as tax sponge, or ways that we within the overall like end of the year, here's your one number refund you're going to get or the amount you're going to pay, all these input factors go in. What are some things that stand out to offset hopefully large capital gains?
Yeah, so it's a hard question to answer simply because everybody's situation is different. So, yeah,
Yeah.
if you have real estate, then you can get into the discussion of like, well, I've got depreciation on the property that I've already bought, and that's going to create a phantom taxable loss. How much of that loss is usable is going to depend on what my total income is for the year and whether, we're actively participating as a real estate professional or, a lot of people have one spouse working and one spouse managing the real estate to build up enough hours to justify all of that. So effectively, there's myriad strategies, but fundamentally what you're looking for is to create deductions against income, and that could be business losses, that could be depreciation type of losses, that could be charitable losses, depending on the numbers involved. So this is what we talk with our clients about is like, well, what's your situation? Okay, we have these 17 pieces. Okay, let's figure out what we can do to make your particular situation as good as you can. Now, I will say for your clients in particular, there is, if you're taking policy loans for funding your trading accounts, then there is a concept in tax called interest tracing. So if I'm paying 6% on a policy loan, then that is going to count not just as general interest, but it's going to count as investment interest, which goes into your Schedule A of itemized deductions. So that is something to keep in mind. You have to pay it though. You can't let your balance accrue up and never pay the policy loan because policy loans are flexible in that way that most other loans are not.
How does
So
somebody track that? Like, how does somebody show that and what the function of that loan was, especially when you consider that, like, from one policy, as you know, Neil, if I take multiple loans for multiple things, it
yeah,
just shows one document. So
yeah,
how do I do that in a taxable way? How do I report that, document that,
yeah.
and use
So
that
what
strategy?
you would want to do is you would want to create. I mean, I hate to say create a spreadsheet, but it's basically what you'd have to allocate.
Someone love that.
Yeah, you'd have to allocate however much, what percentage of the total is applied to the investments, and then figure out how much of the interest that you paid back to the to the insurance policy, how much of that was allocated to the investment activity. And so basically the way it works on a tax return is on the interest portion you have on your Schedule A, you have mortgage interest, and then there's going to be a box below that of the investment interest paid. And so if you're in the itemized territory, which for a long time we didn't do any itemized because in 2017 the standard deduction doubled and nobody was paying any mortgage interest because rates were so low. But now that's changing. So people are getting $50,000 interest paid statements from their mortgages, and so they're getting kicked into itemized deductions once again. So if you're in the territory where you are potentially itemizing, then you can get an extra deduction from that interest. But you got to do the allocations. You got to be able to trace out, okay, this chunk of money went into the investment account, and therefore this percentage of the interest I paid is allocated to that and is deductible.
So
Yeah.
it might be wise for people that have a system of policies then to use one policy if they want to allocate some of those funds and just use that particular policy for investment purposes if they can.
Yeah,
But
if possible, that's
there's
simpler.
there's a lot of strategies that you could use, obviously, to tie infinite banking into the trading or any other investment for that matter. And is that true for all investments now that we can itemize that?
Yeah.
So if I use it to purchase real estate, same thing.
Mhm.
So, okay. So like one of my things with the trading, one of my thoughts is let's just use $10,000 for easy math at 5%. If I wanted to take a policy loan of $10,000, put it into my brokerage account to trade with, the best bet might be to just at the end of the year or the end of the policy year, withdraw from my brokerage account, pay the $500 in interest once a year until I've satisfied a point where I want to start paying that loan back. So then it's just one full transaction every year. Would that simple?
Yeah.
Is that, and then you're saying I could take that $500 and write it off on an itemized
Yes.
Schedule A, you said?
Yes. Because in the low stress options world, you're settling to cash anyways, then yeah, you can take the money out of the trading account without, because you've already sold everything, hopefully. And then you can pay back the interest and then refund the account and just start all over again. So yeah, that works.
And so for clients, what you need to do is go to your loan balance. If you have multiple loans that you've taken for multiple different purposes, it's just going to show one number and one interest accrued at the end of the year. But you can look at your transaction history, and so I could go back and Brian said 10,000. That's what I borrowed from my policy or against my policy to put into Schwab. So I could go in and say, here on this date, October, whatever, I took a $10,000 policy loan, and the next day you can see I deposited 10,000 into my Schwab account. So that kind of tracking, it would behoove you to keep all of those notes so that when they work with you or with their tax preparer, that they're ready to go. But this is a good point to emphasize that you should not be doing this by yourself. Like
No.
you should not just be doing your, what I did for 10 years, get my discount on TurboTax as military officer and try to do this myself. You should absolutely not be doing this. You need to talk. You need to either reach out to us. We'll put you guys your scheduling or booking link in the show notes, but you need a team that does this for you professionally, because there's so much you're going to miss if you try to just go at this yourself. So please do not try to figure this out on your own. Have a Sherpa to get you up to Tax Mountain here. So
Yep.
About the mortgage interest deduction, was there changes in the big beautiful bill for that? I know that was one of the things that was back and forth, and you were sending out updates to your clients about they're considering this. Here's how it could happen. Okay, if they've done this, here's what changes, etc. What's the takeaway on the mortgage interest deduction?
After a whole lot
noteworthy?
of back and forth, they just kind of ended up locking in what they had already done with the 2017 reform, which is for mortgage balances under $750,000, you can deduct the interest. It's kind of it. So depending on the loan and the house, obviously real estate prices are rising and rising. So I think the average right now is about $450,000 for a purchase in 2025. And so that's middle of the road. If you're in a high dollar market, you might be spending 1.2 million, right? So you're only going to get a deduction on the balance amount that is under 750,000. So a lot of people are confused by this, and they say, "Well, I paid 50 grand of interest. Why don't I get $50,000 deduction?" Well, because 23 of that was above the 750, and you have to prorate that. But yeah, effectively the One Big Beautiful Bill just took the Tax Cut and Jobs Act and said, okay, this is the way we're doing it from now on. And as all things, Congress from now on means until we pass a new thing. So we get a big tax bill about once a decade. So figure 2030 something, we'll get a change on that.
Cool. I have 2 questions, and then we can jump into some of the client questions. Drawdown strategy. You get to the point, you're tracking your weekly income that this is generating for you. You get to the point where you actually want to start using this. Is there anything to think about, any ways to optimize when you're actually going to take deductions? This might get back to tax loss harvesting or something. Do you sell a certain type of position, maybe a position that's at a loss or something in order to capture some tax benefits there? Or as the options expire, as money just goes into the account, do you just do a simple online transfer, withdraw money, because there's really no way to optimize there? Is there anything to think about when we're doing drawdown here?
Yeah, so if you're purely doing just options trading and everything is going back to cash every week or 2 weeks, then yeah, just take the money out and that's it. But if you have longer term holds, then you do want to preferentially sell the things that either have long-term gains, because the rates are about half of short-term gains, or the ones that have losses that can help offset these other things.
One more question. This is a kind of an ongoing debate, not a debate, but just back and forth. Some guys in our group have set up custodial accounts for their kids. I took the route of just opening up another Schwab brokerage within my platform. It's my account. I just named it my daughter's names, and I'm trading. I use a policy loan from their policies. I'm going to trade for them for years, forever, as long as I'm alive, and just keep growing that money for them. And that could be a college fund, car fund. That's if they rental property, whatever they or just expenses, gymnastics lessons, whatever. But like that's an account that I'm going to trade, earmarked for them, but it's still under my control. Other guys went the custodial route where they opened up a custodial account where they have the power to trade it, but then that adds some implications of the money has to be, according to Grok, apparently, one of the guys was kind of going down the rabbit hole of like, how could I mess this up? And you need to trace the transactions from the kid's bank account to the custodial brokerage account. So their value in a Roth IRA is very clear there, because if you have a custodial Roth for the kids, then you're pretty much just removing all the tax consequences. So it's worth the workaround of having to put trace the money into the account, do it the right way. Because then once you're in there, it's off to the races, and it's it's not got to wait 60 years for them, but
Right.
it's tax free. But for just a brokerage account that I'm going to be that they'll be accessing, drawing from, we're not trying to do the the IRA side of things on this. Is there any value to a custodial account? Because my thought was I'm paying taxes on this every year, whether it's them or me. I can get, what is it, $3,000 or $3,400 of kitty tax, so I can shield basically, like I might save myself, the way we worked out the math was about $500 a kid at an assumed 24% tax rate.
Yeah.
Is it worth the headache of this? There's no cost basis consideration down the road, because I'm paying taxes and resetting that every single year. So it's not like we're talking 20 years of investing and then transferring cost basis, right?
Right.
Any thoughts on that?
Yeah, you are basically right. So kitty taxes are when you have kids that have investment assets and they generate income. And so you get the first couple grand, or I should say kitty taxes kick in once you get above the first couple grand of investment income. And so if we're talking, significant amounts of income, there's not a huge amount of difference between, filing or between having a custodial account and having it in the parent's name. It's because of the kitty tax issue, because that is a loophole that has been, cut off through the kitty tax system. It does get more complicated if you are also if you also have kids that are working in your business and you're paying them a payroll. And it can continue to get more complicated depending on the amounts of those things and how that interacts with the standard deduction. And I had a new wrinkle thrown at me last year. I was in a class talking about getting financing for colleges, and the custodial accounts will count against the student if they're applying for financial aid, whereas if it's held in the parent's name, then it's considered the parent assets. And so it's just a random thing that you could run into if and when that becomes an issue. Now, I know fewer and fewer people are sending their kids to college, so that might be not, maybe that doesn't matter.
Nice.
But, for those people who are going through that process, that could be a wrinkle, a very unexpected wrinkle, if you do set up those custodial accounts. But yeah, the bottom line, there's not much tax benefit to doing that way. And there can be a couple downsides if you don't do that tracking accurately and things like that. So for me,
And it's also restricted on usage too,
Yeah.
right? Like you It's not like you could go buy them a car with that money.
I mean, you
Because
could.
that's
You just
oh, you
close.
can.
You
Okay.
can just close the account. But yeah, you're creating, in my opinion, you're creating more complexity for no benefit.
Okay. Cool. All right, I'll just run through some of these questions here because the guys, obviously this is front of mind for everyone. So I'm wondering about real estate LLC being used to write off capital gains, if that's even possible. We kind of addressed that, and situation specific, but anything else on using a real estate, not just having properties, but a real estate LLC.
Yeah.
Is there any
So
distinction there?
Yeah, I mean the distinction is if you have an operating company, like it doesn't have to be real estate, just any operating company. So that's generating a taxable loss for whatever reason, then that's going to lower your overall income, and so that could affect what rate you're paying on those short-term capital gains. Depending on the numbers involved, it might eliminate, the entire thing. So again, the difficult part is like everything depends on the exact specifics of what's going on. So, but by and large, if you have a company that you own that's throwing off taxable losses, then that's going to lower your overall tax, regardless of any other factors.
Okay, so it's not that it's real estate LLC, just an LLC.
Yeah, just
can
some
service
operating
it.
company.
Okay, cool. Is there a difference between taxes on selling option versus taxes from profits of selling a stock, or is it taxed the same as selling a stock under 1 year?
So as long as they are not index options, it's the same. So and I don't think anybody in list options is trading index options. So there are indices like the NDX and the SPX, which is different than the QQQ and the SPY. So there are ETFs out there that represent indexes. There are mutual funds out there that represent indexes. And then there's the index themselves. The index themselves do have options trading. And if you trade those, then you get a 60-40 split on long-term, short-term capital gains. But again, I don't think anybody in low stress options is doing that, but it is out there. So, fun fact, my mentor who used to work on Wall Street was actually involved in creating that 60-40 tax treatment for index options.
Now, just because this might have gone right over my head. When you say index options, with like QQQ or something that's tracking an index fund,
No, not a
an
fund.
option on an index fund, is that what you're talking about?
No. So that's just a regular option.
Okay.
So if you trade a QQQ option, that's just a regular option. But if you go to the NDX, which is the NASDAQ index, there are options on that, right? And so if you trade those options, then you get 60-40 treatment between long-term and short-term.
So SPY would be the same thing?
Not SPY, SPX. So two different things.
Or SPX, yeah, sorry.
Yeah.
Okay. All right, gotcha. Okay, so we have two that are on the professional trader, and I think the takeaway was that none of us are going to qualify, and none of us should try to. But when would it make sense to create our own stock trading business for the tax shelter? I think this is what Troy does, so he doesn't have to pay as many taxes at the end of the year. Once my balance is around 500K, it may make sense to set up something like that.
Yep.
Then also pay my kids like he does. At what point is the juice worth the squeeze to start a stock trading business for the tax shelter?
Yeah, I mean, $500,000 is probably in there. Because again, so like Troy is running an active business, right? There's low stress options. They're doing advertising. They have all these different expenses that would not be deductible to a passive trader, right? But because this is part of the business, then okay, now it makes sense to have an active status where you're looking at the overall growth in equity and then deducting against that all of your other expenses. So I would say in that $500,000 range, that starts to make sense. But again, you need the expenses to have, right? So you can accomplish a similar kind of effect if you just have the passive income from the options trading, and then you have active operational losses from a different business. So it's not necessarily that it has to be tied together.
Okay. All right. This is one of your new clients. This is Hank. So he's got his LLC set up. Orientation will be real estate management, trading consulting / education, and trying to work some agriculture in. Neal briefly discussed registering as a professional trader to help shelter some of those earnings, but would need to be early in a tax year, so 2026 at the earliest.
Yep.
Didn't discuss a specific account size, threshold for it to make sense. Want to revisit that. So again, that's almost the same question. But
Yeah.
my question on that would be, do you want an LLC that's doing all of these disparate things? Should you have an LLC for each of these ventures, or does it not matter?
Yeah.
And then I guess back to the professional trader question.
Yeah. So the election thing, it has to be done early in the year. I think it's 75 days. I'd have to check on that. but it can't be done in November for the year, right? It's got to be early on in the year. And then the other question, on a tax basis, it doesn't really make a difference if it's each one individually or they're all in one. There is, and this is a question for the lawyers, there is an issue if there's a liability exposure in those different things. Do you want to have those assets in the same place? Because let's say, like in real estate, for example, this happens all the time. I've got 3 properties. Do I put them all in one LLC or do I put three different LLCs? Like, well, depends on how paranoid you are, right? So somebody slips and falls outside of property A, they're going to sue the owner of property A, which is some LLC. If they win, and there's other assets in that LLC, then those are exposed for that particular lawsuit. And, maybe you have insurance, maybe you don't, obviously it depends on what actually happens in that lawsuit particulars. But if they're in separate LLCs and you can keep them separated, you're not commingling funds or anything like that, then, those other assets are more protected from that liability exposure. So if you're doing 3 different things, you could do them all in one LLC, but it may not be a great idea just from that liability exposure perspective.
If you don't have your properties in an LLC, is having a large umbrella policy sufficient in that, encountering that threat, or do you want to, no matter what, get the LLC set up?
Again, that's a legal question. So sufficient is, I don't know, depends on what happens, right?
Yeah.
So I will tell you that
if you have much more than the properties are worth, for instance,
so
let's say you have,
I will tell you that all my lawyer clients that have real estate, they all put them in an individual LLC.
that's good
They
enough.
put each property into its own.
Yeah.
Yeah.
All right, that's a good takeaway. Everybody write that one down.
That's our writer down
And
there.
schedule a call with Neal. Okay, cool. We got a couple more. Brian, you got anything else before I run through these? Any other comments or stuff?
I had something a long time ago, but I'll wait till the end.
All right. Troy talks about crypto taxes being complex. Why? He says he likes to trade crypto-related options versus get into crypto because of this.
I mean, it depends on what you're doing. So the problem with crypto taxes, and I actually wrote some articles on this a long time ago. So in 2013, the IRS stuck a flag in the sand and said, we're treating cryptocurrency, or virtual currency as they called it back then, as property. So it's the same as a cup, right? So if I buy and sell a cup, it's a gain or loss just like anything else, right? So that part's fine. So if you're treating cryptocurrency like a stock, where you're just buying and selling, it's all the same stuff. It's short-term capital gains, long-term capital gains, all that's fine. The difficulty comes in is when you start to do things outside of just buying and selling. So, for example, in DeFi, in decentralized finance, there are contracts, right? That they're smart contracts that you can interact with. Now, the way the IRS has issued guidance over the years is they say each token is a unique thing, and if you exchange one token for another, it's going to be a taxable event, either positive or negative, right? And that's not even getting into NFTs, which is a whole separate thing. So let's say I have Ethereum coins, right? And I take those Ethereum coins and I send them to a smart contract, and in return, I get a new token that represents the position inside of that smart contract. So, I've talked with lawyers about this, and we've kind of walked through the mechanics of this. Because what happens is you had an Ethereum token, which was worth, I don't know, right now it's, actually I haven't looked lately. Let me go to you. Right now it's about $3,000. So I have one Ethereum token worth $3,000. I exchanged that. So that's a taxable event according to the IRS. And in return, I got this contract representation token, which is worth nothing. Okay, I cannot sell it. There is no marketplace. So on the IRS's logic, that became, I took a $3,000 asset and I sold it for $0. Now, that creates a capital loss. On the flip side, if I then take that contract token and exchange it and get my Ethereum back, now I exchanged something worth $0 and got back something worth $3,000. That's 100% gain. Okay, so, and that's just one example, right? The problem is that there is no legislation regarding cryptocurrency and taxes, and the things that have evolved in the cryptocurrency world with things like smart contracts just don't have an analogy in regular property. Like, I can't do that with a cup, right? So that gets compounded by the fact that, okay, all this guidance was issued back in 2013, and they had a couple updates over the years. And now we have the Raimondo case with the Supreme Court. And that Supreme Court decision tells us that if there is no legislation, then an administrative agency's interpretation is not binding, right? So, and this has wide-reaching effects, including things like IRS guidance. So, the fact that they decided it was property back in 2013 is kind of like, well, that's your opinion. There is no case law. There is no legislation. So we'll see until they actually rectify that. So there have been a couple cases over the years that really haven't gotten to a good resolution with like things like staking rewards. So if I stake a token into a contract and that contract pays me over time, then is that income? And the IRS says yes. Other people have said no. One argument that was made is that it's not income until you sell that thing that you received. So, and the analogy that they used was baking a cake, right? So if you're a bakery, you have flour, you have sugar, you have yeast, whatever. You don't get taxed on the individual components. You get taxed when you combine the thing into the cake and then sell it, right? So the fact that you combine it into a cake doesn't count until the sale happens, because it's just really, really ambiguous at this point. I think Troy's point about trading options is possibly a fair one. So if and it kind of depends on what your motivations are, right? So most of the OG Bitcoin people are buying and holding Bitcoin because it's a short against the fiat system globally and the US dollar in particular. And so if that's your point, then I would say, yeah, just buy the Bitcoin and sit on it. If the point is just I want to make money, then trading options on it can make a lot of sense.
Okay. So endlessly complex
Yep.
and mostly ambiguous is taxation of crypto and crypto derivatives.
Yeah.
Simple short-term capital gains on something like a put on IBIT is if you just want the dollars. All right, that's a good summary. All right, I got one more. Buying and selling the same stock within 30 days invokes a wash sale rule where it disallows loss carryover for taxes. Does being put a stock invoke this since you didn't buy it?
No.
Or I guess it's collecting a premium. Selling a put, I'm guessing, is what he's trying to say. Selling a put, you didn't buy it yet. And so
I think
essentially
he's saying
ask about wash rule.
I think that means if you're assigned.
Yeah. So assigned from the put is not the same issue as the put itself, right? So buying and selling a put, buying and selling a piece of stock that put is on, two different securities, does not invoke the wash sale rule. However, if you're writing puts on the same stock over and over again, and then you get assigned in between there sometimes, then the stock itself you've owned and sold and bought and sold and bought and sold. And so you might have a wash sale rule inside of there, even though it was on two separate put contracts.
Okay. So you could sell a put, get assigned. 2 days later, the stock shoots up and you sell it for a profit. That's not a wash rule. That's just you have taxable income on the gain.
Right.
Or conversely, the stock stays down, you sell it at a loss. That's not a wash rule because it's a one-time thing where you got assigned and then sold.
Yes.
Is that accurate?
Mm-hmm.
Okay, cool. All right. Well, I think that's all the questions we've got. Brian, what did you have?
I want to share my screen real quick. All right. So this was the very first month of trading. I started off with about $14,000. You can see I down here at the bottom added 2,383 through the month. These are my deposits.
Okay.
Now, if I look at what I tracked as far as options income, it was $1,378.
Okay.
Schwab, they're saying that I have an unrealized gain of 428 right now.
Yeah. So you have open
I know
positions.
It doesn't show that 1378. It doesn't show that on here. That's just what I tracked from the options income.
Right.
And every one of these, for the last few months, I pulled up 3 of them, and we don't need to see them all, but they show a very small gain or a loss in comparison with the options premium that I collected.
Yeah.
So is my tax basis more or less going to be, this is just for anybody that's watching this and wants to look,
Yeah, so
And
you
you
can
can go right
see
into the tax documents section of Schwab. Is it going to be based on the summation of 12 months of whatever it shows here? Even though
probably.
that does say unrealized, which I realize that's unrealized,
Yeah.
but
Well, you see how that cost basis is negative?
yes.
So that's premium you received. And so,
Okay.
when that all settles out, that's going to turn into basically negative 429 plus the 428 is going to end up with a taxable gain of, the difference there.
Taxable loss. Yeah.
Um,
Well, and could that be because, through the end of the month, some of these positions were rolled and that money was tied up, we'll call it,
yeah.
accounted for. It was securing the positions I'm in.
Yeah. Yeah, so these monthly summary ones, like if you look up here at the gain or loss summary, you see gain 687, loss 93, unrealized 428.96. That's when those settle out, that's probably going to be it's going to be close to your gain, hopefully.
Of
Yeah.
1,300 of what he's seeing in the tracker, you mean?
No, the tracker has nothing to do with it because
Okay.
it's just the change in market value is I don't know what maybe you're carrying stock from before, and maybe it's from things you got assigned. Who knows, right? So like I said, the best way to do it is not on the monthly statements, but is on you could run a capital gains report for the year, like year to
Okay.
date.
I didn't see that. I
Yeah.
looked, but okay.
I don't use Schwab personally, so I'm not sure about what their reporting is, but most brokers have something like that, and they can just sum up the historical trades throughout the year, and then you have whatever you have open, which is unrealized profit or loss, and then you can figure out what you're actually looking at from a tax perspective. I'm just looking at my account here to see if I can find anything. I haven't done a whole lot of trading, but let's see.
So right now we're just going to have to rely. I mean, I think it's going to be good. It's going to be a good case study come this upcoming tax year when a bunch of us have tax returns that reflect this, and we can actually get a year-end statement.
Yeah.
Hopefully, we'll be able to find, or you will be able to recognize patterns and see consistency and be like, okay, I see what they're doing here. Here's why you're getting these numbers that you are. Month to month, it might be kind of confusing, and it might be hard to really tell until the end of the year. You could get a ballpark idea, but I don't feel like I know any more about how they're actually calculating this. But at the end of the day, it doesn't really matter because we're going to use that number. And I think that just don't be looking at your low stress options tracker when you're trying to figure out what you're going to be paying taxes on. Just rely on your brokerage statement.
Oh, here we go.
That's as close as you can get for now.
So this one shows a lot more.
Yeah. So total proceeds, total cost basis, gain loss. So this is showing you have a net loss for the year.
Yeah, and it makes sense because these last few weeks to months have been just rolling forward as the stock market's gone down. So that's showing those as currently unrealized losses,
Yep.
which will turn into losses December 31st if it remains that way.
Yeah.
Okay, which is kind of cool.
Yeah. So
That's good. So good.
Yeah.
As long as you're not trying to draw down, and that's the distinction that, when you're in like, I'm tracking this, I'm building up my capital, I want to see where I'm going to be at in 5 years kind of thing. That's where I'm going to use the calculator on the low stress options website. But when I'm in drawdown mode, I don't want to use those numbers because I need to look at what's actually there. And so as long as we're in this kind of like rolling and continuous growth thing, we actually want to see that net loss there, and rolling out into the future is going to show on paper that unrealized loss, which helps our tax situation.
Yeah.
That's probably why most people are seeing better results in taxes than they're expecting to. But that is actually cool to see. I haven't seen that specific graph on the Schwab site before.
Yeah. So it's somewhat analogous to the difference between cash accounting and accrual accounting. So if you have a business, you have two choices. You can do accrual or you can do cash. Cash means when I get the money, when I spend the money, that's when I count the thing. Accrual means I'm taking into account, like, if I sign a contract and I am owed, by this customer $10,000 over the next year, I've got to book that now, right? So, in the low stress options tracker, my guess is that they're kind of looking on that long-term accrual basis, saying what's happening overall with my mental position of I put in $5,000 or I put in $10,000, whatever the number is. as opposed to, on the actual tracking that gets reported on taxes, it's the cash in, cash out, and what's happening in each individual transaction. So they're just answering different questions, basically.
Yeah. Okay. Well, cool. For anyone who's, again, this should be on the top of your to-do list to get actual tax strategy put in place by someone other than you. And so if someone wants to reach out to you guys, can you give us your little pitch about what your process is if someone wants to reach out and they're doing, whether they're just W-2, maybe they have an LLC, maybe they have a rental property, they're doing options, whatever. What does it look like to do an exploratory call with you, and how does that process work?
Yeah, the process is fairly straightforward. You go to taxsherpa.com. There's a link on the top, book an appointment, and then you'll get on our calendar. And so the first step is figuring out where you are. So we call that the survey. And we're gonna talk about your family situation, your work situation, if you own businesses, if you have investments, if you're doing trading, or you have real estate, whatever the case is, right? We talked to a woman this past week. She's got, I think, 6 different businesses she's running at the same time, which is crazy. But and they're all pretty much making money, which is surprising. But so we have to map all that out, and then we take a step back and we look at the whole picture, and we'll say, okay, here's what we're at right now. Here's what you're looking at tax wise, and here's the things we think we can put into place as far as getting to a path towards saving as much as we possibly can, given your particular facts and your particular circumstances. And so, and then we'll have those discussions. It's like, okay, well, here's what we think we can do with A, B, and C. And if we do this, it's going to change your destination to this better mountain over here. So I was just working on a client's tax return like an hour before we got on. And in their case, they had some equipment that they bought. And how we treated the equipment affected how the tax return came out, whether it was money owed or break even or a refund. And so, we can make those decisions once we figure out what actually is going on. So the biggest mistake people make is they wait till March or whenever it is that they file. And they say, okay, here's all my stuff. It's like, well, okay, now it's too late because we can't make these adjustments throughout the year because we're already after the end of the year. So whether you go with Tax Sherpa or hopefully not on your own, but wherever you go, do your planning now, especially as we get into the year end. And nobody works in December anyway, so now is the time. And run those reports like Brian just showed and see what you're actually looking at from a tax basis as far as your trading goes and all the other things that you have going on in your life, whether it be day jobs or real estate or what have you. So it takes work, and the biggest problem people have is just sticking your head in the sand, hoping it works out at the end, and maybe it does, maybe it doesn't. But if you do the work ahead of time, then you'll actually know what's going to happen.
And if you give Neal and Tax Sherpa a call, you'll get to work with his lovely assistants Serena and Fatma. I don't know if you guys didn't say much, but how do you guys
I talk
help?
too much.
So I step in just to make sure that all clients are taken care of. So you will speak to me for your discovery call and also the route call. And then you'll always have Fatma too. She's our assistant. She's actually both of our assistants. I stole Fatma from Neal.
She did. She stole her.
Other than that, we're here just to make sure that you're proactive planning with your taxes and not just, coming to a service once a year. It's all about being proactive, and we're here to help.
So I will tell your audience the same thing that I tell a lot of people, is that for me, and some people have different opinions about this, but for me, let's say your tax bill for the year is $50,000, right? I think taking that $50,000, going to Vegas, putting it on black, and then losing the $50,000 is a better use of money than sending it to the government. So
true.
You're still out the 50 grand either way, but at least one is with private enterprise through voluntary transactions, and the other is taxes. So that's my approach to the world.
I love.
Yeah, that's great. We have 2 previous episodes with Neal where you can go back and kind of hear his background, how he got into this, and a lot more discussion about taxes. But I'll just say that one of our clients who's going through underwriting right now, about to put some IBC policies in place, set up a call with you guys, and has been doing his own taxes. If you think that I work W-2, I don't have all these other fancy things going on, so I can just do my TurboTax or whatever service you're using. He's an airline pilot, one rental property, and that's about it right now that's going on. And it's looking like they're going to get a tax return of $30,000. And they're used to filing it themselves and maybe getting a small return. But that's because you guys put in place a lot of different strategies beyond just what you're going to find when you plug and play and put the numbers in yourself. For myself, you guys went back 2 years and looked at my previous returns and said, hey, not only did you jack this one up, dummy, but you also missed all these things the last couple of years as well. Now, of course,
Say that.
the Treasury took those returns from the IRS due to my debt from the mandate stuff. So I never actually got those returns, but they were filed. And so, yeah, don't think that you can't use solid tax strategist based on your situation. It is at a minimum worth your time to set up an exploration call and see how it might help you. So
Absolutely.
that's all I got. Anything else, Brian, Neal?
Nope.
Serena, Fatma?
Nope.
Good.
All right, cool. Well, thanks for tuning in, everybody, and we'll catch you next week. Cheers.
Have a good one.
Have a good day.
All right, see y'all.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
This is Brian and Hans signing off.